afternoon. Welcome to another edition of AircraftPost Rousseau Report. I'm your host, Dennis Rousseau. We took a couple of weeks off toward the end of the summer, and now we're back. And boy, is there a lot to talk about. There's a lot of volatility in all areas of life today, and it seems we couldn't pick a better time to speak to unprecedented business jet markets with regards to pricing and availability. But first, a primer. In October 2005, I spoke at the Rousseau Aviation Professionals Conference and predicted that our economy lacked fundamentals, and all the signs pointed to a global recession. There was not one person in an audience of 200 plus that didn't think I was out of my mind. The business jet industry was on a high that many thought would never end. Pre-owned aircraft selling prices were on the rise. And by 2008, they were selling for 20% more, dig this, than they did new. The only other instance where an aircraft brings a premium is when a new model enters service, like the G650. The first one that came to market sold for 18% more than the original buyer paid new. The same scenario played out with the first pre-owned 550, 7X, and I feel certain the same scenario will apply to the first Longitude. Well, similar to the run-up in 2008, there's an exuberance in our markets today. Buyers are not making informed decisions, but rather letting their emotions rule, and when this happens, selling prices get crazy, and buyers throw money at these depreciating assets. Keep in mind, a depreciating asset. That reminds me of what's going on in the residential real estate market, but I'm getting a little ahead of myself. First, let's look at a standard value curve for business jet depreciation. And I say standard because this is the methodology our bank clients employ. Plus or minus 7% year over year, and then run the value out over 30 years to salvage value, or the sum of the parts. Whatever you can get for the engines and subassemblies, that's your end-of-life value. OEMs warranty the aircraft structure for X years or X hours, and the majority will hit the calendar long before the hours. After that, you're on your own. A couple of other factors that weigh into end-of-life are technological and economic obsolescence. Now, by way of example, avionics that are installed today will most likely serve operators well for the next 15 or 20 years in terms of capability, regulations, and operating environment, after which we'll be faced with some other mandate that will require upgrades or replacement. That's the technological side of the equation. Then we're faced with the consummate question, at what cost? And that's the economic side. The cost of ownership becomes greater year over year, and will reach a point where it exceeds the value. So now the question becomes, when do you stop throwing money at it? Using a 30-year-old G4 as an example, you'll typically refurbish the interior and repaint the exterior every 12 years. Engine inspections are required every 4,000 hours or 10 years. Airframe inspections every 6 years. The first one cost on average $125,000. The second, $300,000. If you fly an average 400 hours per year, in 30 years, you'll have accumulated around 12,000 hours total time. A gear overhaul is due at 5,000 cycles, or in this case scenario, around the 20-year mark to the tune of $750,000. So essentially, you're spending 30% of its value for an inspection. And it's not just the ongoing increase in operational costs. Corrosion has become a major issue with all business jets, and some are being written off because the cost to repair exceeds the value. Similar to most markets, we have fluctuations. As history has shown, just prior to a recession, we see an uptick in selling prices. Note, I said selling price, not value. After which, prices return to a standard depreciation or value curve. 2020 and 2021 are circled because in March 20, the IMF's managing director announced we had entered a global recession. And based on some of the economic indices we use, I'd submit we're still in it. But so as not to pick on any one aircraft, as we look at other legacy aircraft, we see similar fluctuations over time, as demonstrated with a 1998 Challenger 604 or Falcon 2000, a 1999 Global Express or G5. So regardless of the aircraft model or category, they all face ongoing inspections, refurbishment, upgrades, life limits, and market depreciation. So what are some of the precursors that signal a market decline or uptick? Just recently, Yellen announced that if the U.S. government defaults on paying its bills, we'll slide into a recession. Since early 2020, central banks have had to choose between pursuing financial stability, low inflation, usually 2%, or real economic activity. Without exception, they opted for financial stability, followed by real economic activity with inflation last. These banks need to be more proactive because global stock markets and real estate are overvalued, while leverage is near record levels for households, businesses, banks, and governments. Let's take a closer look. In the run-up to the 2009 financial crash, banks were throwing crazy money at home buyers. In 2005, homes were selling at a rate of over $7 million per month at inflated prices. Then investors securitized thousands of mortgages and tried to sell them as investment-grade assets, which were all overvalued. Fast forward, today private equity firms are buying single-family homes, paying 25% above asking price and outbidding normal home buyers. Yes, house prices were rising at a record pace. Unfortunately, incomes aren't keeping up, which is making traditional homeownership less affordable. In July, for the fourth consecutive month, prices rose at a record pace driven by a shortage of available homes. Do you see the corollary thus far? Everything starts at the consumer level. Did we learn from the past? Today, we're back in a similar scenario as 2005. Only it's the Fed that owns 21% of mortgage-backed securities. The stock market index was at 5,000 in 2010. 11 years hence, we're just under 35,000. It's baffling. What's propping it up? The Federal Reserve is putting a lot of money into it. And as I just mentioned, they're not only buying mortgage-backed securities, but also corporate bonds, something they've never done before. The stimulus package is also a result of this unprecedented rise. Similar to business jet markets, there's a lot of expectation or forward-looking optimism factored into pricing. But keep in mind, companies that contribute to the index are not representative of the economy. Small businesses are laying off staff, closing their doors. Unemployment is a major economic driver, and when we look at the real unemployment rate, it's staggering. Can we believe the statistics from the Bureau of Labor? I don't think so. What they're not telling you is that in August, 4.3 million quit their jobs, up from 4 million in July, the highest on record in 20 years. But you don't see that statistic in the stock market nor unemployment. Big negative signal, and that trickles down to our aircraft markets, just as it has historically. Another indicator is the U.S. commercial real estate market, specifically vacancy rates. In 2011, the commercial real estate market had its highest vacancy rate since 1993, 17.4%. And as of Q1 2021, we were at 18.3%. Fast forward. Commercial real estate vacancy rates in major markets range from 20 to 27.3%. And that doesn't include projects currently in development. Here in Denver, our vacancy rate is at 20.5%. And as of Q2 2021, we have 3.3 million square feet under construction. That's akin to aircraft OEMs building twice the amount of production in anticipation of future buyers and hope they show up. Percentage provides one perspective. Let's view it from a different angle. New York alone has near 500 million square feet of space, or 500 million square feet. It's vacant, and that doesn't include properties under construction. I think people are doing just fine working from home. So who's going to fill and pay for office space? Or the bigger question, who pays the utilities every month, the taxes, ongoing maintenance? The numbers are staggering. And surprise, we've been here before when our markets crashed in 2009. As a side note, China has a problem similar to what the U.S. experienced in 2008. They overbuilt real estate, in some cases building entire cities, and there aren't people that can afford them, so the properties just sit. One of their major developers, Evergrande, has over $300 billion in debt that they can't pay, and they're on the verge of collapse. Going one step further, China's cutting off electricity 1 day a week, and manufacturing companies are only working 3 days a week. The Chinese economy is in trouble. It's not that it's coming, it's already here, and it's affecting the global economic scene. Let's now trickle down to some consumer fundamentals. Higher energy prices may benefit energy producers. However, they're an inflationary risk for companies like airlines, and they impact consumer spending. By way of example, WTI, West Texas Intermediate Crude, was at $20 a barrel in 2020, just last year. As of October 15th, we're now over $80, and the consumer is feeling it at the pump. Over 30% increase in climbing for a gallon of gas. And of course, this also affects jet fuel. As the price increases, the airlines get hit and their stock goes down. But wait, I thought the stock market was on the increase. Something doesn't smell right. Another indicator on the consumer level are used car prices. Not only is it difficult to get a new vehicle, most can't afford a used car anymore as prices near the cost of new. Another consumer fundamental is that of housing. Prices have doubled in only 10 years, pushing many consumers out of the market. But remember, what goes up will come down. This all translates to one component, CPI, Consumer Price Index, not core CPI of 3.4%, the one the government uses. That number excludes food and energy, but real CPI of 5.4% and rising. Think about this, in 1 year, we went from 0.5% to over 5%. Gas has gone up 68% in the last year, and that's not 5.4%. Whether it's sugar, coffee, corn, or soybeans, all of these basic food commodities have been rising. What does it mean when inflation takes hold of the economy? The price of everything goes up and kills any economic growth. A major inflation crisis began in 1972 and didn't end until 10 years later. It was blamed on a number of factors, but bottom line, it was the then monetary policies, financing massive budget deficits supported by politicians, that was the cause. The inflation and the recession that followed wrecked many businesses and individuals alike. I could draw corollaries all day between economics and the respective impact on business jet pricing. 30% increase in marine fuel prices, which affects the container ships that transport consumer goods across oceans. Over 100 ships sitting offshore due to labor shortages and nonsensical regulations in California. The Baltic Dry Index. It's an index that measures the amount of goods traversing our oceans, up from 500 12 months ago to 5,600 in October, in less than a year. The business jet market has always lagged the general economic pulse, and today's no different. By way of example, the valuation methodology we use for business jets is mark-to-market, with one caveat. Because they're depreciating assets, prices will not go up, but rather maintain at the level they were prior to the run-up. Now, if we look at one market in particular, in 2020, G550 pre-owned sales versus mark-to-market or AircraftPost value had an average delta of 1%, meaning we track, then post a value by serial number. When the aircraft sells, there's 1% differential between the selling price and our value. We have nothing to do with the sale. 2021 was tracking about the same. Then things started to get crazy. In Q3, relative to our values, we're worlds apart. The pre-owned business jet markets are stocked with exuberance. And when prices are bid up, it promotes word-of-mouth enthusiasm and heightens optimism for further price increases, and we lose sight of the fundamentals. Are sales and inventory up year over year? No. However, if the pre-owned markets continue at their current pace, we should end up just shy of 2020 results. How are new aircraft deliveries faring? And let me be clear, these are aircraft that were purchased in the last year or two and are now being delivered to the buyer, which is one of the fundamentals we use to gauge the strength of the markets over time. From 2015 to 2019, in-service deliveries averaged 512 aircraft per year. 2020 shows 468, and year-to-date, 2021, 351 through the end of Q3. If we stay on pace with the first 9 months, we should equal or exceed 2020's total. Our industry has a few newcomers, or aircraft in development that should be real game changers. Gulfstream's G500, 600, with Pratt & Whitney engines, are selling very well. Bombardier's Global 7500, Cessna's Longitude are performing the same. Dassault is coming out with the new 6 and 10X, Gulfstream announced the new G400 and 800. So there's a lot to be excited about, provided we don't forget the fundamentals. By understanding market timing, owners can be better positioned to buy and sell. Where does the market go from here? Uncertainty in and of itself can serve as a catalyst for panic that can result in a market meltdown. And there's plenty of uncertainty in the markets. For Aircraft Post, I'm Dennis Rousseau. Thank you for tuning in, and we look forward to seeing you soon.